Do rates tend to come down during an election year?
The Fed has raised rates too fast.
It wouldn't surprise me, I mean, obviously, but I don't think it's as easy as they say it is. The only thing that really could help rates at this point is if
Mortgage business isn't going good.
It is for guys like him. There was always kind of, if you paid your loan, no one was bothering you. But I don't know if that's the case anymore.
it's not as simple as everyone makes it seem.
What's the availability for commercial mortgages like? Are you finding it's a lot tighter? Hello, everybody. I am Rob Nixon. This is my co-host, Dominic Ciccarelli, and we are joined by the illustrious Nick Aversa, managing partner at Charles Martin Mortgage. Really need to get the background of that name, but thanks for being here.
Thanks for having me.
What's up, pal?
Not much.
How's life?
Things are going good, thank God.
Yeah.
Family's good.
Mortgage business isn't going good.
It is for guys like him.
Well, I mean, industry down 50%. It's you're working twice as hard, obviously, for in some cases half as much. But it's a cyclical market, so you have to expect the ups and the downs. Through 2020, 21, 22, as you ring the register, never before, you have to prepare for and understand that these downturns come. So
we have a ton of questions about the future of mortgages and people that got into these really small interest rates during COVID. But before we get to that, so tell us a little bit about yourself, where you came from, what made you start your own brokerage, and how you came up with the name Charles Martin, because I think that is a big question everybody wonders.
So as far as getting into the mortgage business, I guess I was waitering actually through college. I attended Hofstra University, obviously born in Staten Island. I attended St. Peter's Boys High School, and was waitering at Vincent's Clam Bar, if you're familiar with it. They've got a Mott and Hester location, which is the original, but they also have a location in Call Place, New York, which is just outside Hofstra's campus. And I was waiting on a table, of a friend of mine who had recently graduated, and he was in the mortgage business working for a mortgage brokerage company. And like any good friend, he shows up, I'm waiting his table. He's breaking my chops, and the banter begins. There's a whole bunch of guys that I knew at that table, and they were relentless. They were out to dinner with their boss that night. And of course, with the banter, I'm back and forth at the same time, handling the table very well. The guy that took them out, the owner of the firm, had asked me what I was taking up in college at that time, and I graduated with a degree in finance. And I guess he was kind of like impressed in a way that I was able to really take all the banter on the chin and come back, pretty sharp with it, and still manage to work the table. And he offered me to come in for an interview.
Wow.
So yeah, so I went into the next day, interviewed, and never, carried a tray again, unless my wife asked me to. But so that got me into the mortgage business, and then worked there for a couple of years after graduating college. Worked for a company called Mortgage IT. They were the largest privately held mortgage bank in the United States. We wound up going public while I was there, and ultimately we were acquired by Deutsche Bank. I worked for Deutsche Bank then for about a year or so, just before the financial crisis. And then my job turned to like triage and winding down that business. The guys I worked for, my managing director and the vice president of retail, was nice enough to understand that I wanted to continue my life in the mortgage business and not take any job internally there. So they allowed me to make an application for my New York license while I was working there. So it was full disclosure. And then, after that was approved, I moved on to my firm, which was just about when my children were born. So around April 2008.
Now, you were living in Staten Island, commuting to Manhattan to work for the Deutsche Bank.
Yeah, it was downtown Maiden Lane, 33 Maiden Lane.
Yeah. So now the collapse happens, and you say, I want to stay in the game.
Well, you say, what else do I know at that point? And, it was a risk I could take at the time because I didn't have children. I wasn't debt laden. I was very smart with my money. I had a very good run at a young age. So I was financially secure enough that I could just, throw caution to the wind and give it a shot. Not knowing that when Freddie Mac and Fannie Mae became conservatorship with the federal government, they then instituted through the federal government a HARP program, which basically disregarded your loan to value, really threw the appraisal out the window, which was very helpful since values were sliding tremendously over that
What
period
year
of
is
time.
this?
8, 9, 10. That product was around for a handful of years and really helped launch my business, to be honest with you.
Wow.
And so what was happening was, as businesses were closing, as mortgage companies were closing, mortgage banks were closing, the demand then spiked while the supply of mortgage personnel, mortgage providers, mortgage sales guys, it was dropping like a rock. So it was an arbitrage situation for me, and I took advantage of it. It wasn't really planned. It wasn't me being super smart. It was kind of luck, but I guess lesson learned, take a chance, and sometimes things go your way.
Definition of luck is when opportunity meets preparation, right?
Well, you make it sound a lot better than I do, so that's good.
So Charles Martin, where does it come from?
So as I was sitting in my office at Deutsche Bank, my wife, mind you, is pregnant with twins, and I keep getting notice that the name that I selected for the firm was rejected. I'm going Hudson this and Pinnacle that. Really trying to bring it into that mainstream sound that you hear when you hear
Stratton Oakmont was taken.
So, so now we're coming to a time crunch, right? My wife's like third trimester, right? I got to get the show on the road here. And I had stickies all over my desk with names because I didn't have to hide anything. It was all, like I said, open book. One of the guys that was a manager for me, a dear friend of mine that I grew up with, actually, you know him, Fred Willica.
Okay.
So he came into the office and I said, "What do you think of this?" And I handed him the sticky with Charles Martin Mortgage on it. Charles Martin. He said, "It sounds distinguished. It sounds like it should have a bust of an old man, like as the logo." And it was clean. And the origin of it, my full name is, so I have the same middle name as two of my grandparents, my grandfathers. One is Ciro and one is Martin. So Nicholas Charles Martin Aversa. And so it's a piece of me without being, outright a piece of me.
Right, not calling Nicky Aversa.
I don't think Nicky Aversa Mortgage would have really rang too well out there. So it's worked for me so far. And that's the origin of the name and how I got in business.
Very cool.
Yeah.
What would you say your business up until COVID focused on?
Well, I mean, we've always been kind of a niche brokerage where we are able to help find a home for a loan with a very specific and unique scenario, which we continue to do through COVID. But like any other mortgage company, we became a conveyor belt to a 3% rate. And of course, I think post-COVID, with people being pent up in their home, they had a new appreciation for how much they didn't like their home or the home that they would wish to have, since now remote work and things like that really took hold. So there was obviously a lot of that movement. So I guess I would say during COVID and post-COVID, shortly post-COVID, the name of the game was just, keep our head above water because it was busy. Yeah. It was busy. And, I think I tested and stretched the staff I had. But, constantly reminding them that this was just a kind of a flash in the pan moment. And looking back, we wouldn't want to have a regret that we didn't really capture as much business as possible. You don't want to say, I wish I should have, spent a little more time at trying to originate loans or trying to close more loans. So everyone that came out on the other side of that, obviously financially rewarded, exhausted. And then now post-COVID, the market looks a lot different. Both from a product standpoint, from a customer standpoint, and I think that what clients are, the whole industry, homeowners, investors, got a really robust education. Anyone who hadn't been through the refinance process, I don't care if you bought your home 2 years before COVID or a year before COVID, you have potentially refinanced once or twice now in a short period of time. So we have a lot of people out there who know a lot more about the process and a lot more about what they're looking for than would typically be out there. So everyone's an educated customer now. Plus they have Google, so.
Well, right. Well, I think you're in a unique spot. I think like myself, my business is very, and yours too, very, for whatever reason, boutique has a negative, word to it. I don't think it is at all. It's niche. I think that it allows you to, you can shift, right? So you can go and ride those refis and the residential 3%, but those guys that only did that are dead right now, right? And you're in a position where you do a lot of construction financing, QM stuff, really hard money. You do some really creative products. So
We do.
I think that's really cool. And honestly, I think that provides a lot more value than a lot of other people because you can really help them through the good and the bad times.
Yeah, I don't disagree, and I would add that also adds stability. Because if you have one product line and that's all you offer, all you're at the whims of that particular product with that particular market. I think there was like something like a crazy number. I think it was like 25,000, maybe even 40,000. Forgive me for not knowing the exact number, but unique NMLS ID numbers that were issued just as rates dropped during COVID. And what that tells us is how many people entered the business.
Right.
Those people entered the business and they, listen, you can have a monkey could sell a loan at 2.5%. So I think a lot of people are exiting the business too.
Ton of people dropping out.
Which will, ultimately help. Listen, I started my company in 2008. There's that whole arbitrage situation, where you're swimming against the tide, but then out of nowhere, it opens up for you. And I think that with rates in the 5s, which is soon, I think, around the corner within the next, 12 to 18 months, listen, hopefully there's 30,000 people who have potentially left the business, found themselves a good job. They're passionate about it, but I'm happy that they're not there because
you get them out of the way. I feel that way about the realtors too, man. I think it just because it created too many people that weren't true professionals. I think it made it look bad for the industry. It just, especially with all these changing laws in the real estate industry. I mean, it happened with you guys regulation wise, some years back, but I think it's very much happening on the brokerage side, and people need to wake up and realize, so product wise, right? What are some? So I won't bore people with the 15 to 30 year fix. People can Google it. Right. They see it all the time. That's what you hear. But like, what are some, especially for investors, business owners in general, like what are some really great products for people that, maybe are in businesses that fluctuate a lot, self-employed people, right? So like, what are some cool products?
So out of necessity, products have been born over the past I would say 8 years. A lot of regulations relating to ability to repay kind of put a complete halt on your ability to make a loan to someone who didn't have the traditional type of income, maybe was retired but had investments or had a business that was very tax friendly, and that kind of took those people out of the market. What has happened is we constantly solve problems, right? And then if you solve the problems, you make money. Well, there are now products that have alternative ways to document ability to repay, and then bringing those people back into the market, those investors, self-employed people. So for example, if you want to buy a multifamily property for investment, but you don't necessarily have the tax returns to carry that deal, there's now loans that underwrite purely on what's called DSCR, so debt service coverage ratio. And what they do is they look at the rent roll or potential rent roll, market rent roll of that property. And as long as the rent roll covers the principal, interest, taxes, and insurance on generally a 1-to-1 basis, you're good to go. If the rent's a little weak and doesn't cover the payment, principal, and interest for the loan that you're looking for, you could actually qualify that deal on an interest-only payment. So it gets a little more aggressive. You could purchase buildings that are vacant. They'll use them.
Getting back to that, right? To be specific, what do LTVs look like and what do rates look like in that scenario?
So what we've seen is as time has gone on, they're seeing that these loans actually do perform because generally speaking, you have people buying these properties who are investors, right? They're people who are seasoned. They know what they're buying. They know how to manage properties. So the performance of this paper has been good enough that they're starting to take LTVs up at this point. Yep. Plus the lenders are in competition to see who can capture the business. I think on a multifamily right now, on a purchase, you can get an 80 LTV loan, 20% down.
Is that 2 3s and 4s?
2 3s and 4s, 25% if you get into the 5s to 8s, and on a mixed use, you're 25% down.
Rates?
So, I mean, if you're a good boy, you pay your bills, and are we talking rates at those LTVs, those high LTVs, those 80s and 85s?
You mean both.
80s and 75?
Give me the 80 and then a 50.
Okay,
60.
so an 80 right now, you'd be in the high 7s, low 8s. You could get interest only in the mid 8s, and then if you have a really good LTV, you could look like a conventional loan.
Which is sitting in the mid 6s somewhere.
Yeah, so mid to high 6s on a 50 LTV loan, and that's in some cases even better than a conventional loan because you really don't get too much of a bonus or concession for that low LTV on a conventional investment property.
Is that 30-year money?
30-year money. In a lot of cases, the interest only is an interest only period for 10 years. And then at the end of the 10th year, it converts to a 20-year amortizing loan.
Entity owned.
Yeah, preferred actually. That's
Right.
that's preferred, and it's actually required to stay in New Jersey for
So
prepayment.
meaning it has to be owned in an LLC. For
Well, it
those
doesn't
who
have
don't
to.
know,
In New Jersey,
or-
they do.
Okay.
Yeah.
Yeah.
Okay. All right. So that's one product. You were
Yeah.
going to another one.
So that's the DSCR product. Self-employed. Okay, I own a bunch of pizzerias. We all know that pizzerias have
Tax-friendly business.
Tax-friendly business. But
Good
you're
way
very,
to put it.
yeah, you're a very successful
Tax-friendly.
entrepreneur, and you have a good business, and you're depositing money in the bank to cover the expenses for the business, payroll, whatnot. If you own 100% of that business, I can give you 60% of your monthly deposits, your average monthly deposits. 60% of that number becomes your qualifying income. So if you have a business, regardless of how product intensive it may be, you may own a construction business, and a lot of the money that is expensed through that business is material, right? They don't even look at that.
60% a monthly. Wow.
So let's just say you have a business that does $1.2 million a year. Let's just use easy numbers, right? So the average
100,000.
deposits is $100,000 a month. I'm going to give you $60,000 a month in qualifying income. The world is your oyster at that point. You could get whatever you want. I mean,
Literally.
obviously it's credit driven. You know, they're not looking for someone who's a first time home buyer or anything like that.
I think most of those guys have good credit.
Yeah. Well, listen,
So it's
they
the
know
form
that
of-
without good credit, it's tough to facilitate your business.
We're talking about a traditional loan, not like a small business loan. This is like a traditional,
traditional real estate loan, yeah.
Yeah.
Primary
real estate loan.
residence.
Right. So in that case, you qualify for 720,000.
No,
No,
700,000
we're
in income.
we're using 60.
You can buy anything
it
at that
would be
point.
as if you have a $600,000 personal income,
Wow.
a $600,000 W-2. That's the qualifications that you have when determining the loan amount you qualify for.
That's amazing. That's
And what do those
amazing.
rates look like?
Same, high
Wow.
sevens. Yeah. I mean, listen, depending on when this podcast actually broadcasts, people may say, "Hey, you said high sevens," but because rates have been moving like that.
Yeah.
Right.
That's interesting.
Okay.
Wow.
So you were mentioning a deal. We won't go into names or anything, but you were mentioning a pretty cool deal that was a completely dilapidated building, right?
Yeah. Well, it has to be in most cases. It has to be rentable, right? Livable. So it's got to have all the components. If it's a residential building, it's going to have all the residential components like a stove,
kitchen, working
Yeah,
plumbing,
yeah.
et cetera.
But you lose points on the appraised value for condition, of course.
Mhm.
But as long as it's livable and rentable, there's a market value. There's a market rent associated with that unit. So if a building's vacant, such as the mixed use that you were referring to, that had 2 empty stores and 2 empty apartments, and we were able to finance that at 75 LTV, based on market rent. The market rent is obviously included as part of the schedule in the appraisal. And that's it. I mean, again, reserved for those with superior credit, good assets, things like that. We're not just throwing everything out the window, but you have to you have to be able to check all the other boxes.
That's amazing.
Yeah.
I have 2 questions. I think these are questions a lot of people are wondering. Without getting deep into politics, traditionally during an election year, regardless of Republicans or Democrats, do rates tend to come down?
So
Because everybody's saying, "Oh, it's election thing," and I vote. I keep saying it myself, but maybe I'm not right.
Well, I mean, it wouldn't surprise me. I mean, obviously, going into an election, the current administration is always looking to have everybody happy, and think that they're in a better spot than they were when they entered office.
Right.
So have more of a likelihood of being reelected. Obviously, it's not as simple as everyone makes it seem. It's not like you could just put his finger on the scale and make the rates go down. There is a lot of economic reporting that goes into determining where the Fed funds rate is. That is what is a point of confusion for a lot of people, is that the Fed funds rate, that rate that you hear that is going up, that our Fed is increasing their interest rate or lowering their interest rate, or the rate may come down in the second half of the year. That rate is a short-term overnight rate. And while it's important and really affects the cost of doing business for corporations, guys who have HELOCs and things like that, it's not a direct driver of mortgage rates. In fact, I've seen instances where prime rate has come down, and prime rate will come down when obviously economic conditions call for it. So there's a slowing, unemployment, things like that. And then what happens is you'll have a sell-off in the stock market, and rates won't move as much as you thought that they would because of all the things being intertwined. That being said, to lower mortgage rates, you're going to be looking more on the longer end of the bond market, and you're going to want to see yields come in on that. Right now, it's remarkable. We have actually an inverted.
Inverse yield,
Yeah. So I mean, if you borrow as the federal government on a 13-week cycle, you're paying like 5.2% in annualized interest.
Right.
Whereas if you borrow for 10 years, you're paying about a 4.2% interest. So you're paying more money to borrow on the short end, which is, my finance degree did not teach you anything about that.
Right.
So, I don't think it's as easy as they say it is. I think that the only thing that really could help rates at this point is if the Fed went into a QE stance where they completely about-faced, and instead of raising rates or holding rates where they're at, not only do they lower them, but then they go into a QE cycle where they're purchasing securities, purchasing bonds. And by creating the demand on the bonds, you increase their price and lower the yield. And that would translate into a lower mortgage rate. But I guess it's anyone's guess. At this point. That's what I would say.
So you obviously use the term off camera of the golden handcuffs, right?
Yeah.
The guys with 3% mortgages, right? All these people with 3% mortgages. In your opinion, because you talk to borrowers constantly, what do you think it takes to drive that change? Because in my opinion, it's going to be layoffs, right? Because at the end of the day,
You mean for rates to come down, or for people to just
for people to
Have to refinance
have to sell
into a higher rate.
or because
sell.
everyone's just not selling right now, right?
Yeah.
And they have that advantage, and they have that unique ability to do
they
that.
have their golden handcuffs?
Right.
Yeah. So I guess if you want to say like where do rates need to be for people to, give up their warm and fuzzy blanket of a 3% and move on to say a different rate,
Somewhere in the fours.
I
fives.
think it's mid fives, and I think there's a lot of forces that would push people to kind of walk away from that 3%. What you don't realize is right now we're at like the highest credit card balances in history. Credit card debt is at all-time high. And that's not because people can't make ends meet. It's generally that they're spending the same way they normally would on their credit cards. It's just that for however long, 20 years, there's been a down cycle on rates. So generally speaking, the broad look at credit card balances has been being chipped away at through refinances. Because people are saying, oh, I get to go from 4 to 3.5 and knock out my credit cards. Or even if they keep the same rate, but knock out $30,000 in debt. So what has been happening is that through home equity, through refinancing, a lot of the credit card balances have been taken off the table and put into a home loan. And because we have a stalemate in refinancing because of where rates are, those credit card balances haven't been dealt with the way that they normally have over the last couple of years. So it's funny.
And that could be a big driver.
Well, you know what? We see it, and we see it very clearly. So as of next week, actually, our firm launches a home equity line of credit product because we understand that, listen, golden handcuffs. You don't want to move right now, and you're certainly not refinancing away from a $400,000 balance
For
2.5%, 3% to consolidate $30,000 in debt. It just wouldn't make financial sense.
Right.
So we have now partnered up with a provider who's providing an insane HELOC product that is going to allow our clients to do the necessary repairs. Maybe they're not going to sell because they have the golden handcuffs, but never thought that they would be stuck where they're at, stuck in the home that they're at. So now they want to do a roof raise or renovate that basement, but certainly pay off credit card debt if they have it. And this product will allow for them to do that without unwinding their first mortgage. So, and when I first got in the business, everyone had a second mortgage. Everyone had a second mortgage.
Is that right?
Yeah. So what we did, was consolidate a lot of that, right? Pay off the first, the second, or whatever credit card debt or, cash out that they may have needed. But second mortgages were pretty prevalent. They had a lot of different lenders out there that only did. I know you all grew up to the money store,
Yeah.
Phil Rizzuto. So all these companies that did Champion, your bank says no, Champion says yes. They were also a big home equity lender. So everyone had a second mortgage. I think we're going to enter that phase again, and we want to be out ahead of it. So we'll, as of next week, be able to offer all of our clients a really
So what's that
aggressive
look
home.
like?
So it looks like up to 80 LTV. It's 80 CLTV, combined loan to value, right? So if you're $1 million home and you have 600,000, you could borrow up to 8 with the combined balances. So you have 2 you could take out on the HELOC.
Are you seeing lower appraisals? Speaking of that, actually, the answer is probably not because I haven't seen values change.
I
on the
think
realtor
that
side,
this
right.
inventory situation is keeping values pretty much pegged. I'm not seeing them being bidded up. In some cases, if you have a realtor who's chosen to list the house at a low price point to create that environment. But other than that, I think we're pretty stable.
So 80% CLTV.
CLTV.
What are the terms?
So it's going to sound like a high rate, but it wouldn't have been a high rate 2 years ago, 3 years ago when prime rate was down. Anything tied to prime it seems expensive.
Right.
Construction loans,
Yeah.
which, we have clients that are paying, prime plus 2, that's 10.5, for
Prime to
construction
what
loan,
now?
8.5. So this is going to be a prime plus 2 to a prime plus 3 product, depending on the LTV and credit score, which seems like a very high rate, but it's less than half of your credit card.
I was going to say,
balance.
you know what? It sounds a lot better than 30% on your credit cards.
Yeah. And by the way, if you're investing in your home and you get to stay, I mean, what price tag do you put on being happy too, So
What are the terms of them?
so it's generally going to be a 5 to 10 year interest only draw period. And then at the end of that draw period being when you could take from and put back, the payment during that period is an interest only revolving payment as your credit card would be, right? Where you're paying based on the outstanding balance. At the end of the 10th year, it converts to a amortizing loan if you want to keep it that long. If there's not an opportunity in the next 10 years to consolidate it into your first mortgage, which I think we're all hoping is the case.
Years ago, comparing those interest rates, you can get hard money for 10%.
Yeah.
And now you're getting a home equity line for 10.5. But now the hard money guys that want 12 plus when lending money. But
I mean, 14 in some cases. I mean, that's what we're seeing now. Yeah, because it's relative. I think unless you live under a rock, I mean, that mortgage rates on conventional stuff have been in the 7s, and that higher risk stuff has been in the 9s and 10s. So if as a private lender.
Yeah, and don't forget us, who's been in the game maybe 15, 20 years, think these numbers are very high. But I remember in like the late 70s and the 80s, I mean, my dad's mortgage was like 18, 19%. Right.
Yeah, but the problem is the prices have gone out of control.
It's
That's the problem.
Kind of relative.
Yeah, he bought the house for 30 grand.
There hasn't been that inverse relationship that there always was. I mean, prices have pretty much been unaffected, at least in a certain bracket.
The bigger problem is that the incomes haven't really. If you look at all the cost of a home and the cost of many other consumer goods, and you look at that as against the income growth in the country, that's really the bigger story. That's the problem. It's not that houses have gone up so much and rates are high. It's that incomes haven't kept up. And what you're seeing now, and because of that, the 3.5% rate that was out there, floating around for a couple of years, really drew those first-time home buyers in, or those second-time home buyers that were living in a semi-attached home, had 2 kids or a baby. Mm-hmm. They're 35 years old. They're both professionals.
Yeah,
they can sell their semi, make a couple $100,000, and then parlay that into a $1.2 million one family. They've evaporated.
Right.
They've disappeared. They're staying in their semi, or they are trading out of the house they have here in the city and going deeper into the suburbs or even into another state, Florida, New Jersey.
Or you're seeing people sell and rent.
Yeah. We have a couple clients like that right now, but they're just parked looking for the right home. But so
I mean, we're in an interesting time from that standpoint.
We used to joke around during the pandemic, the whole, refinance and crazy purchases that were going on. I would joke and say, we're all refinancing ourselves out of a job, out of business here. And I would say jokingly, never thinking about, obviously recognizing the fact that when most of the population is at an average rate of 3.5, rates go up, every tick of the rate going up is less customers, less clients, right? But never thinking about the golden handcuff situation that would ultimately emerge afterwards.
It makes complete sense also.
Hindsight's 2020.
And it makes complete sense why credit card debt is at an all-time high, because no one knows how to manage the money. They were used to paying that 5% mortgage rate, or they assumed they were going to pay a 5% rate. When you plug them into a 3, they didn't take that extra money in savings and put it away somewhere. No. They just used that to just frivolously spend it. So it just shows you again how the mass just can't be given all this extra money and it's just going to be spent.
Yeah, I think things are changing very quickly. When the whole concept of a starter home is, I mean, a starter home is what, 900,000, maybe 800.
It depends. It depends. The definition of starter home has changed so substantially in price, although it has. But I think the definition of starter home has changed more in definition. I don't think that young buyers are looking to buy that fixer upper. That hey, we'll do the bathroom this year, and then in a year or two we'll put some money together. So the generation that is now, is an instantaneous generation. It is a Amazon Prime at my doorstep, the next day generation. The idea of sitting and waiting to do the second bathroom a year or so, or doing the kitchen maybe a year or two after you buy it, doesn't fly. Doesn't fly. So that's a personality that's in conflict with what a first time home buyer should be buying. Right. And I mean, that's my opinion. I mean, you see a lot of these houses out there that are in good spots in terms of their location, maybe need a roof raise, maybe need a couple bathrooms. And these buyers that are of first time home buyer age are kind of walking in, walking out, or maybe not even walking in.
Well, right. Well, I think though there was always that. Let's use Staten Island just for an example purpose. There was the semi-attached house, right? It was in the 3s, and it's the 4s, and then it was in the 5s, right? And those stories always were the same of, bought it for $450, sold it for $700, and now you rolled it into now the $1 million house right up in Jersey. But that's very hard to come by now. And then you're seeing a lot of these people now go to Jersey, and now Jersey new construction for the most part is all these townhome projects, which to me are going to plummet in value. That's just my opinion. $700,000 for a townhome that you're in, connected on all sides, up, down. To me, I don't see how those don't plummet in value. So it's just not following the trajectory it once did.
Listen, sometimes we don't get, we're too close to the forest to see the trees, and I think for years people said, wow, I can't believe the house is this much. I can't believe it's gone up this much. It'll never go up any more than this. And then you drive, through Brooklyn, and you see a fully attached, 50-year-old, 3-bedroom home, and it's $1 million. So I think, that semi story will continue to, bear fruit later on. If someone, 10 years from now is in the house that they were in today, they will absolutely have enjoyed, an appreciation.
You're probably right. It's more so just harder to get into that now.
Yes. That's for sure.
Because the income growth hasn't gone up
seen a lot of gifts.
Yeah.
A lot of gifts. Thank
Thank
God for the
if-
generous parents out there.
I was going to say,
Keep it coming.
lucky if you were though, I didn't have that option.
no,
I got a
me
lot of
neither.
friends that are doing that, and their families are helping them. I wasn't in that position.
It's almost unattainable without
help,
without a gift. So you see a lot of them. As far as like disposable income post mortgage payment, it's tight. I see it. It's tight. I mean, do they qualify based on guidelines? Yeah, but I always have that conversation with first-time home buyers or those who are looking to stretch their monthly payment within guideline. But within guideline doesn't necessarily mean you're not hanging yourself out to dry if something goes wrong, or you have another kid, or you want to take a vacation.
Yeah.
So we have those discussions with our first-time home buyers, trying to, in some cases, reel them in. But generally speaking, they're already in love with the house, and
right.
they're hearing wah wah wah.
So we'll get to a story, but I really want to cover quick, just commercial. So what's the availability for commercial mortgages like? Are you finding it's a lot tighter? And I'm curious if you've seen any impact from like the signature fallout, for example. Are you hearing? I've heard stories. I don't know if it's actually happening or if it's rumor of banks actually going in and calling notes, really, really tightening up on things that once there was always kind of, if you paid your loan, no one was bothering you. But I don't know if that's the case anymore.
So, there's that expression, don't let a crisis pass you by, or don't miss the opportunity in a crisis. I think a lot of people let a lot of people go during COVID and like downsize their business, which is something that is a difficult thing for any business person to do, is let someone go. But when you have the backdrop of, a pandemic, it kind of helps make that decision a little easier and, explain it away. I think that we absolutely have issues right now in the regional bank area. There's a lot of loans that were made. Take one example, right? So a bank that's local here, I won't even use names, but they were into multifamily heavy. And what has happened in New York specifically because of, landlord
Rent stabilization.
Right, sure. Yeah. So you have margin compression going on where I got a loan in 2019. Rates were still good in 2019 pre-pandemic. It wasn't like we only had good rates during the pandemic. So you could be at a 4 on a 5-year adjustable commercial loan that resets every 5 years. Well, it's resetting now, right? 2024. And
8%.
Well, I mean, it's something that is way more than you're paying now.
Right.
And then when you take into consideration the cost to insure that building has gone up substantially.
30% at least.
Your utilities on your landlord meter for your lights, for your elevator, for all the common areas, to heat that area, to repair that, material costs, things have gone up. So now you have the profit margins that are getting compressed already because of the cost of just operating that building. And then you have a reset on the rate. And then that's it. It's really, there's no money there. It went from an asset to a liability overnight. And those loans that are, now the owners may pay, but those loans become scrutinized by regulators, and they say, you know what? given this particular, criteria, we're going to need you to reserve against that potential loss. Instead of, pennies on the loan, it becomes dollars on the loan in terms of reserve. And that ties up cash for a bank. They can't make investments, and they can't make, the loans at the volume that they would, which is, you would want them to make loans in this rate environment, because getting that yield, instead of having all the 3 and 4s on the books, putting some 7% money on the books is really healthy, right?
Mhm.
But when you tie up all that capital, it really gets in the way of doing business as a bank. And it becomes just a downward spiral. Now, that's the story that's going on a lot around here in New York with some of the banks. It becomes a liquidity issue because that money becomes locked up. But when I was saying earlier about don't let a good crisis, pass you by, or don't miss, seizing the opportunity in a crisis. Listen, banks have been looking to pull back. Banks are always, looking to protect, their depositors. At least you would hope they are. But when you hear this whole story swirl of the regional crisis, right? The Silicon Valley Bank, the Signature Bank, and then Flagstar coming in, and then that whole NYCB mess, and then obviously that last week they halted trading on that name. It was a liquidity issue. Anyway, all that. It could be isolated. I don't think there's contagion going on, but what is contagious is the attitude, because the regional banks then take the opportunity to kind of reel in, on those bases, like, oh, we're being extra prudent now. So the decisions that they wanted to make, that they would have left them less competitive in the market, they now can make in lockstep with one another, and therefore bring down LTVs, throw away certain property types, and they're not touching them. Listen. When these things happen, they take a hard look at their books and decide how they want to do business going forward. Again, with the I want to say the excuse, but the motivation of what has already happened, and the theme of what has already happened, kind of. So I don't think it's as bad. I don't think it is as bad as everyone thinks.
It's a correction.
Yeah,
it's a correction. I do think you're going to see, I do think you're going to see, maybe not so much locally, but I think you're going to see a lot of defaulted notes. I think there's a lot of multifamily syndication deals that scare me. I've seen a lot of those decks that were showing rent growth significant, right? But they were showing expense growth going down, and now you have this whole rate environment changing. So you're going to see cap rate suppression. So I just think there's a lot of factors there. And I think we're a little isolated in the sense of where we are, right? So we're between the golden handcuffs and everything else. We're in New York. We don't see it as much. But when you speak to some people like in middle America, they're really struggling. Right? And I don't think those rent growths are there. And I just think in general, I don't think the country's doing well right now.
And that feeling, that potential reality is what ultimately will usher in rates. I personally think that rates will come down, right? So we were having that presidential discussion earlier. I don't know. I think that it may just coincide with the election cycle. Right. But that story is very real. I think that people are, a lot less comfortable than they were financially. And I think the market knows that. And I think the talking heads know that. I think the analysts know that. And I think that that's why there's this idea of rates coming down. They know it lies ahead. They know there's some rough water ahead. They know that there's potential recession, the R word.
Right. Even if they come down, they're never coming down to what they were.
No. But they don't have to.
No.
They don't have to.
I agree.
2s and 3s will never happen again.
But I think also what's been going on in this, just kind of get off mortgages and just talk like, the global landscape of the economy, both here in the United States and globally, is the small cap stocks. I mean, the NASDAQ, I mean, it's crushing it. You got, was it NVIDIA? Mm-hmm. You got all these chip makers, everything that's peripheral to AI just blowing up.
Yeah.
So everyone's looking at the stock market and they're seeing their 401k and they're hearing the buzz around that. And it's like, how could it be so bad? How could we be potentially entering recession? And I don't think that what we're seeing go on right now in the equities market, specifically in the small cap, in the tech side, is indicative of where our economy is really going right now.
I agree with you.
I agree. Nick, you've been around a long time. We always like to hear a story. Like, it could be something exceptional that happened, a surprise. Tell us a story of maybe a deal that you were involved in that went a way you didn't think it was going to go, both good or bad. I mean, I'm sure you've experienced so many different deals in your life. We always like to hear like some crazy stories in your industry.
Yeah, so no deal ever ends the way that you think it's going to end. So
Yeah.
there's a lot of stories, but
Every deal goes in clean and out dirty. Is that the saying?
we try to do our best. But I'll tell you this: this is kind of like a sad story at the same time. But it was about 3 years ago, and I coined a property, the haunted house. I got referred a buyer. It was directly to me, not to the firm, to me, and I handled the purchase. Right. It had to be within a year, or just shy of a year. I get a call that we're doing an equity buyout. They're finalizing their divorce. Okay. You know what happens? I'll happily refinance. And that is when you refinance the loan to remove one borrower, the one that's generally going to be paid out to come off title. Right. Do that. You know, months go by and I didn't know, but the house ultimately got sold. I guess maybe the person that stuck behind didn't feel it was a right suit financially, also an opportunity to make money. I don't know, but it's sold. I get referred a buyer. They're buying the same house, right? I'm sorry. Yes. So the house gets listed. My buyer is buying the house from my other buyer who already bought the house and then unfortunately went through a divorce. They buy the home. I do the purchase. I get a call. It couldn't have been more than a month ago to do an equity buyout. Second time. I'm calling it the haunted house.
Yeah.
You know, so I don't want to see any of my friends buy that house. If it happens to pop up and it comes across my desk, I'm going to let them know that they probably should look elsewhere. But I think that, you know, sometimes, listen, you have a lot of really good opportunities in what I do and putting people in their home in the first time. I can't tell you how many, especially in low rate environments, how many lives you change where they don't think that. There was a client of mine. He lives in Richmond Town. He was retiring from the New York Container Terminal. Good earner, had a lifestyle, but just wanted to stay in his home. He was becoming a grandfather shortly, and there was just no way that he could figure it out. And we pulled a little money from retirement. We refinanced into a really, you know, sharp deal. Consolidated a couple of things that were just hanging out there that just didn't make sense, and made it absolutely possible for them to stay in their home. And I think I get a call from him like every 6 months. You know, just thanking me, like, hey, anything for you, Nikki. You know, I love you. You made it all possible. So there's a lot of good that comes in what we do in terms of putting people in homes for their first time. They remember who put them in their first home from a mortgage standpoint. But I don't know why I chose to share such a dark story. But
no, I mean, listen, it happens.
But it's
a house I designed
remarkable.
On Staten Island, new construction.
Mm-hmm.
Family got divorced, sold. Within a year of it being sold, that family got divorced. Boom. 3 times it was sold, 3 times it got divorced. It's on the market again now.
We should be divorce lawyers. I think that seems to be very resilient regardless of rates.
You're absolutely right. This was great. Thank you for coming, buddy.
Oh, yeah. Yes. My pleasure. Thank you for having me, guys.
I know we can never talk more about this. We do this stuff every day, but there's so much that goes into all these deals and there's so many technicalities and literally day by day the market changes and could swing on how you approach a purchase or a sale. So you're a wealth of knowledge, my friend.
Thank you very much for having me.
Thank you, buddy.
Really appreciate it.
Thank you.
It was a pleasure.